Welcome, everyone. My name is Roxana Isayu. I'm the Chief Product Officer at GRESP, and it is my great pleasure to welcome you all to our webinar. Today, we are discussing the recently published technical guidance for PCAF's Global GHG Accounting and Reporting Standard for the financial industry. PCAF, or the Partnership for Carbon Accounting Financials, is a financial industry-led initiative started in 2005 by Dutch financial institutions. Earlier this year, we saw the release of a technical guidance document to complement the methodology, the accounting and reporting standards for the financial. Today, we are very pleased to hear from the authors of this document. Our plenary from GRET, Professor Sven Wienert representing CREM, and Madeline Schneider representing PCAF. We will then move into a panel discussion with two industry representatives, users of this document. And I will discuss with Angela Paul from PGM, Alana and Elena Alscher from LaSalle about their own interpretations and standards. We are very pleased to see the high number of attendees today, and you probably have many questions, which you can ask via the chat. We are joined today by representatives from GRESP, CREM, and PCAF, who will be fielding these questions in writing, and we will do our best to answer as many of them as possible. But please note that the purpose of today's presentation is to provide a broad framing of how this document relates to the three organizations, and we will likely not be able to answer all specific questions in writing. We can always follow up with more of that afterwards. This is a recorded webinar, and it will be available on demand in about 3 hours after we finish, and all registrants will receive a follow-up email with more information. With that being said, I would like to hand over to Peter Sandel, Head of Climate and Environment at Nordea, a member of the Board of Directors for PCAF, member of the Expert Advisory Group for SBTI, as well as a member of the Sectoral and Managed Phase-Out Task Force for Glasgow Financial Alliance for Net Zero. Just from this introduction, you can see he's a very busy man, so we are very pleased and grateful to have him here today for a brief introduction and to set the scene for the upcoming presentations. Peter, over to you.
Thanks a lot, Roxana, for that fantastic introduction. And first of all, good morning and maybe also good afternoon to all of you joining from different parts of the world. It is indeed a pleasure being here with you today for this webinar. As Roxana just said, I'm Peter Sandal and I'm Head of Climate and Environment at Nordea. And maybe also most important for this context, also a board member of PCAF. And before I hand over to our brilliant authors and panelists, I will share some initial high-level remarks on the role of finance in decarbonizing the built environment and how this recently published guidance helps overcoming some of the challenges the sector is currently experiencing. And if I start with zooming out a bit, we know that the built environment plays a very important role in the transition to net zero. It accounts for almost 40% of energy-related emissions and has also an important role to drive change from the demand side across a number of different high-emitting sectors and value chains. And if we take stock of where we are today, we know that one, the vast majority of buildings are energy inefficient. In the European Union, the share is estimated to be above 95%. Two, the global floor area is expected to increase with 75% from now until 2050, and with the majority of this increase coming in emerging and developing countries. And three, the developed countries, the majority of the existing stock will still stand in 2050. So looking at these three things together, we know that we need to tackle both the growing demand, ensuring that what is being built also meets the standards required in a 1.5 degree future, but also undertake a massive renovation scheme, especially then in developed markets. And I think succeeding with this transition requires a multidimensional approach involving many different stakeholders. We have governments and policymakers, we have companies in the real economy, and last but not least, we have financial institutions. And together, it's a pretty comprehensive task we have in front of us. We need to improve energy efficiency. We need to decarbonize the power sector, build out the grid infrastructure. We need to increase the installations of new on-site renewables. And we also need to find ways to implement strategies that address the embodied carbon from materials. And all of this will, of course, require a massive amount of new investments. I think only on renovation, it's estimated that in the European Union, an additional almost 300 billion euros annually is needed to meet the Union's 2030 targets. And I mean, if we come down then to finance, that sector's role should not be underestimated. Unlocking capital, providing incentives for actors across the built environment value chain will be critical to support the transition. And different types of institutions have different roles to play. I mean, if we start by looking at asset owners, such as pension funds, they are large owners of real estate and must work with their managers to ensure that sufficient actions are taken to transition their assets to net zero. Banks must use their leverage as lenders to incentivize action, especially on the construction and retrofit side, to ensure that those align with the requirements in a 1.5 degree future. And I think also investors in general need to take a more holistic view and approach to engage companies across the whole built environment value chain to ensure that appropriate actions are taken across the whole value chain. And I think that we're seeing that the momentum is building up. We are getting some good news on the fact that positive things are happening across the financial industry. Through the different net zero alliances, financial institutions are now making strong commitments. They are setting science-based targets, and they are implementing transition plans that directly or indirectly cover the built environment. And going a bit more into details, I think this is not an easy task, and sufficient guidance, methodologies, and data is not fully there yet. And in addition, and I think this is especially important given the context of this webinar, compared to financing a company, financing a building is different in terms of correctly measuring, accounting, and attributing financed emissions, and how to accurately divide the responsibilities between the different stakeholders, meaning owners, financiers, tenants, and so forth, is definitely not an easy task. And I think adding to that challenges with data availability, how to properly make estimations and use proxy data is not making things easier either. And what we need is clear guidance that take all different stakeholders into account, and that can enable an accurate way of accounting for, at the first stage, operational financed emissions in a standardized way across the financial industry. And I think looking at this guidance, I believe that it comes a very long way in meeting those needs. It's written by organizations and individuals with deep understanding of both the real estate sector and the financial industry. And also, these organizations are all leading actors within their own field of expertise. And I think that the fact that they have different roles is extremely important to ensure that this guidance also rests on a broad alignment across the wider ecosystem. So I would like to finish off by extending my gratitude to the authors and to PCAF, GRESB, and CREM for your efforts in enabling the financial industry to take a leading role in decarbonizing the built environment. Thanks a lot, and I will be handing over now to the next speaker here.
Yeah, thanks a lot, Peter. I think it's not you that up to you that needs to thank the organizations, but we have to thank you for setting the scene and, of course, for being such a tremendous support while drafting the standard. My name is Sven Bienert. A very warm welcome also to all of you. And my role is being head of the CREM initiative. Now, before we jump right into the details of and results of the guidance, let me just briefly give you an overview of the collaboration between CREM, GRESP, and PCAF in this respect. For our organizations, it was a real logical step to team up on this topic. I guess you all know, as Roxana already briefly introduced the organizations, but I think you all know the organizations quite well. GRESP has been and is the leading and long-established standard for sustainability and real estate benchmarks. It's looking at the broader scale, of course, of ESG, but GHG is in the center of attention at this point in time. CREM is the leading source for operational decarbonization benchmarking and transition risk analysis. And PCAF, of course, is looking at the broader picture of financed emissions and especially enables the banking sector also to decarbonize. Now, why did we team up on this topic? I think at first glimpse, it might seem very easy to do accounting for emissions. It seems to be an easy task to convert consumption into GHG emissions, but as Peter already pointed out in detail, it's not at all an easy task. There's a lot of confusion still out there in the market. There are a lot of conflicting approaches that have been applied in the market. There is, to some extent, no like-for-like comparison. And last but not least, of course, we all as a sector do want to avoid any kind of greenwashing, which is to some extent still happening. So for us, it was important not to reinvent the wheel, not to produce, replicate, duplicate conflicting standards. There is no time to lose in this race to net zero, which we all need to accomplish until 2050. So the aim of our initiatives was, of course, to find a common language, a common guidance on this topic on operational decarbonization and carbon accounting. If we go to the next slide, please. Now, how do we accomplish this topic? To be honest, we've been working on this document, which I guess is underpinning the high quality already from the end of 2021, beginning of 2022. We have set up, of course, internal working groups. We have had a tremendous amount of in-depth one-on-one exchanges with high-level experts, as Peter pointed out, that were not just within our organizations, but of course we were exchanging intensively with SBTi, with Carbon Disclosure Project, with the colleagues from the Greenhouse Gas Protocol, and many others. Last but not least, we did have a public consultation that was actually a tremendous success because a lot of market participants did hand in valuable insights that actually made this whole even more bulletproof than it was before. Now, what are the benefits for users? What are the benefits for all of you, hopefully using and applying the document and the guidance? I think, as we discussed before, there's a great need to have a harmonized guidance. We don't want to have conflicting standards. This guidance is, of course, focusing predominantly on operational carbon, but of course also leverages insights on other parts of greenhouse gas accounting in general. We are covering the full range of direct and indirect investments, debt, equity, and of course, try to shed a light on scope attribution in this respect. As you might be aware, there is, especially if you take into account different roles of our organizations, a difference between carbon accounting for reporting purposes and carbon accounting for other purposes. For instance, if you look at the normalization of greenhouse gas emissions, this is needed for some occasions, but it's of course not needed for others. So there are a whole lot of details that we would like to at least illustrate to some extent already in this webinar within the technical guidance that are hopefully valuable for the industry. Thanks a lot for participating in this webinar. I'm now handing over to the next speaker, which is my dear colleague, Madeleine.
Thanks a lot, Sven, for this great overview, and welcome also from my side. My name is Madeleine Schneider, and I'm the Director of Operations at PCAF and also Associate Director at Guidehouse, which is the global consulting firm that serves as the PCAF Secretariat. So, first of all, I would like to give you a brief context how PCAF relates to this joint work with Gram and Grasp. So, for those of you who are not that familiar with PCAF yet, PCAF is short for the Partnership for Carbon Accounting Financials. It's a global network of financial institutions that work jointly to standardize the measurement and disclosure of emissions of financial activities. And it's also an industry led initiative that was initiated by Dutch financial institutions in 2015 and then launched globally in 2019. And a key milestone was then the launch of the PCAF standard in 2020, which is also very relevant for this technical guidance. And it was updated at the end of last year. As you can see on the map, after the global launch, the number of participating industries has increased drastically. So currently we have more than 370 signatories with an objective to support over 1,000 financial institutions by the end of 2025. And this group has committed to measure and disclose the emissions in line with the PCAF standard. And out of those, approximately 120 have already published their emissions. And PCAF supports financial institutions here also through technical assistance and professional trainings. As you can also see on the map here, Europe is the largest PCAF region. When we still go back to the other slide, um, because in Europe, more than 140 signatories are headquartered. So with this growing number, we felt that we can also build momentum to decarbonize their building portfolios, which is particularly relevant for the old building stock in Europe. So that's why we teamed up with the Laudas Foundation to set up a specific project called Financing Towards Net Zero Buildings to mobilize the financial industry to speed up the building transition towards net zero. So here we support financial institutions on this path by developing various tools and services. And one of these key tools is this technical guidance, where we're really excited to have joined forces with Gram and Grasp, so two key organizations working on the decarbonization of the built environment. And together, we aim to provide financial institutions with the guidance they need to measure and disclose their emissions from real estate. And yeah, it's also an effort for alignment and harmonization of methodologies. So when we go now to the next slide, I wanted to highlight also how the PCAF standard and the Greenhouse Gas Protocol corporate standard relate to the technical guidance. So the corporate standard was first published in 2001 with later revised additions and extensions, and it establishes the framework for greenhouse gas accounting for corporations. So the corporate standard classifies emissions into three scopes, with the scopes highlighting the level of control an organization has relating to the emissions. And for real estate, emissions can be reported in scope 1 and 2, as well as scope 3, category 13, emissions from leased assets, and category 15, investments. Then the PCAF standard builds on the greenhouse gas protocol standards for corporate reporting to further detail and provide a standardized approach to account and report on financed emissions of financial institutions. So financed emissions fall into scope 3, category 15, and refer to emissions that are associated to loans and investment portfolios. So in 2020, the Greenhouse Gas Protocol also reviewed the standard and approved it. And yeah, it got the Build on Greenhouse Gas Protocol stamp. And so currently now with the new update, the PCAF standard covers 7 asset asset classes, with the most relevant ones for building-related emissions, which are mortgages, commercial real estate, and project finance. So to offer clear guidance to financial institutions with all levels of control to account and report on all emissions from real estate operations, this technical guidance was developed. So it's important to note that this report serves as a best practice document. So it's not a standard, but it collects information from the standards and specifies details. This means that it offers specifications to the standards on a range of technical and data issues relating to emissions from real estate. And it also contains specific recommendations on accounting and reporting for commercial real estate to allow for a consistency on reporting. Next slide, please. Yeah, so as already briefly mentioned by Sven, the development of the technical guidance took about 2 years, starting in April 2021. So first of all, us, the three partners, developed the first draft over the first year, and then we shared it with experts in our networks with key expertise in the greenhouse gas accounting space and real estate. And this was then followed by a public consultation in May and June last year, where the draft guidance was available online, and all stakeholders were invited to provide feedback through an online survey. And in addition, we also had a series of exchanges with the Greenhouse Gas Protocol, the Net Zero Asset Owner Alliance, and the Science Based Targets Initiative to align on the methodologies. So based on these consultations, we refined the guidance and now published the first version in March. So we hope that this resulting document provides you with clear guidance and supports you in effectively measuring and reporting, and also setting targets and taking action towards net zero. And now I hand over to my colleague Eric for further details on the guidance.
Hello and welcome everyone. My name is Eric Landry. I'm the Director of Climate Change at GRESB. And so thank you for tuning in today. You'll notice that a lot of my material leverages on the stories told by Sven and Madeline and the rest of the team. So, but I think a lot of this bears repeating to really understand the purpose and the foundation of why this document came together the way it did before digging in right into the details. So, as kind of spoken about before, one of the original kind of purposes of this document was to provide recommendations and guidance on the technical implementation of the standards that PCAF had already provided at a high level. But there was a lot of need in the industry in order to how to actually, with the data that they had available to them in their specific circumstances, to be able to report in line with the PCAF standard. And people were looking for, how does this interact with things like very technical aspects like location-based and market-based accounting, estimation, normalization, floor space measurement, etc. As Sven mentioned, like as we went about constructing this guidance, one of the main things that kind of came to the top was essentially that there was this differentiation between the purposes of GHG accounting. So the two broad, let's say, categories of purpose would be for reporting and then for anything that's not reporting. And for reporting, it's required that this is an accurate representation of what actually happened in a given year. So this needs to be standardized, it needs to be consistent, and it needs to be comparable so that it can be aggregated up into actionable insights by the overall investors. Now, for other purposes, you can still use GHG accounting, but you can use it in a lot of different ways. One example of which is for the assessment of transition risk. And you might want to go ahead and normalize by things like occupancy or by climate zone or what have you, to give you a little more insight into how you would specifically like to manage your transition risk. You can also add in different predictive analytics or forward-looking metrics. But these things can vary from methodology to methodology and from use case to use case, and are often not appropriate for the actual reporting of what you did in a specific year. So these are the two main buckets that kind of fell out of this research. And then finally, last but not least, and a lot of this we heard from our public consultation, was that there was some confusion around, well, when to use the GHG protocol and when to use PCAF and how they interact. And this was one very important point that we wanted to go ahead and provide more insight into the document. So as Sven said, we go ahead and give guidance for how to handle direct and indirect investments, equity, debt, and then also lots of explanation in terms of how the consolidation approaches manifest themselves through different scenarios, including different types of leasing agreements, and then how all of that might be aggregated up in terms of finance emissions in Scope 3, Category 15. So if we go to the next slide, you'll see an interpretation, a very simplified schematic of what some of the relationships in an investment situation. And so the important part here is there's a lot of moving parts. There's a lot of different hierarchies and levels of aggregation. So again, oversimplified for the purposes of this. But if we go to the next slide, just broadly, when we're talking about direct equity, the investors a lot of times will want these under their Scope 1 and 2 because they are directly investing in the asset and they have a significant amount of control over how that asset is operated. And so actually, these are, even though it is financed by the investor, since these are direct, a lot of this is already covered by the GHG Protocol corporate standard. What PCAF has done is it's gone ahead and created a methodology by which you can aggregate up through various levels in the investment value chain to come up with a reasonable understanding of everything that's underneath at the very deepest level, at the asset level. So again, one of the things that's important to mention here is that scopes and accounting is always in the eye of the beholder. It's going to be different from whatever perspective you look at it from. So in this schematic, these categories are referring to what the investor would see these as. But if we were to dig down into a specific layer of the investment value chain, for example, REIT 1, they won't be necessarily following this exact categorization of accounting methodologies. So the REIT will have its own corporate accounting structure, and then it will have its own use of the PCAF methodology if, of course, there are indirect investments under that one as well. So again, always important to remember who is doing the reporting in this case, and then again, part of this guidance is largely around how investors at the highest level can go ahead and work with and handle and treat the GHG Protocol corporate standard alongside and in relation to the PCAF standard. So if we go to the next slide, you'll see sort of the overall or one of the main outputs of this guidance document. And I won't go too much into detail on all the different things shown here, but essentially a lot of this comes down to, well, the GHG protocol allows for any reporter to go ahead and choose the consolidation consolidation approach that's most appropriate for that specific reporter. So it could be equity share, it could be financial control, it could be operational control, and it doesn't take necessarily a stance on how that should be done. Now, this consolidation approach methodology means that there's very different ramifications of how that plays out depending on the types of leases used and depending on the organizational boundaries of what's included by that particular reporter. So that is to say, when we're looking at this graph, this is generally for a direct investor, but there are, of course, instances in which the PCAF methodology will be used. And so you can see that here when we're talking about lenders or we're talking about minority investors, of course, all dependent on the consolidation approach used by the particular reporter. So I'm sure there'll be lots of questions on this, but this is just meant to give a high-level overview. And then, of course, each of these consolidation approaches, should a given investor choose to use one or the other, there are examples in the guidance, and you can see here broken out into very detailed tables on some actual examples on how the math might look if you're going to do one or the other. So on the next slide, a lot of the one of the main questions that GRESB gets is, how does this guidance interact with GRESB reporting? So it's important to take a step back and look at, okay, well, what is the audience of the technical guidance, and then what's the audience of GRESB? So the audience for the technical guidance is the financial industry, as we've said before. And the audience of GRESB is a little bit twofold. We have the output, which is meant for the financial industry, but we also have a lot of, the other side of our platform is essentially for asset managers, property companies, REITs that provide their data to us for us to ingest. And so there are two different sides to this coin. So essentially, the outputs will be the same, and we've done our best to go ahead and make sure that the outputs are aligned with the technical guidance and with the PCAF standard in general. But when you're reporting to GRESB in the GRESB real estate assessment, some of the data that you'll be providing is a little bit different. So, for example, people sometimes ask, well, the technical guidance says that we should try and estimate where we don't have complete data. That way, the investors up the value chain can have a clear understanding of what those look like if we had full data. Whereas when you're reporting into GRESB through the GRESB assessments, you won't be necessarily we have very strict limitations on what you are allowed to go ahead and estimate. This is for a variety of reasons. We use the data in a lot of different ways, not necessarily just for reporting purposes. So we require kind of the absorption of rather raw data. So again, this is just to say that there are different types of reporting, and the reporting that will be done in line with PCAF is not necessarily the same that you will be reporting in your GRESB assessments. But of course, GRESB, CREM, and PCAF have spent quite some time making sure that the outputs are aligned. And then last but not least, you might have seen on the cover of the guidance, this is version 1. Now, granted, it was not originally planned that this would be an ongoing kind of document to be updated year on year. But we do recognize that this is a quickly evolving space and that adoption patterns will differ, and that there might still be some outstanding issues. So the plan is to go ahead and monitor the response and collect industry feedback on an ongoing basis. And then in a year or so, we can go ahead and release version 2 where appropriate. So if you do have feedback on the guidance, how it interacts with different other standards, or comments on how this how it can treat one situation or another for your particular scenario, then do go ahead and provide that feedback to the email shown on the screen, info@carbonaccountingfinancials.com. I wouldn't use this for asking questions. We can answer questions through a different forum. This is just for comments because no one will be checking. The questions sent to this emails won't be answered in that space. But any comments will be aggregated. We'll look at them in about a year's time or so, and make sure that we try and address those perhaps through another publication. And with that, I will hand back to Roxana Isayu to go ahead and host the panel session. Thank you very much.
Thank you, Eric. Thank you, everyone. It is my great pleasure to invite Andrea Palmer and Alina Alschulher for our panel discussion now. We have a beautiful scene set for us, and I would like to start by inviting you to introduce yourselves, please. Andrea?
Yes. Hi, everyone. Thank you, Roxana. And actually, thank you to everyone here, because I think we definitely should not underestimate the amount of work, the amount of sweat and tears that have gone into producing this technical guidance. It was no small task. And we, first of all, need to give big kudos to the group. Bit of introduction from my side. So my name's Andrea Palmer. I'm responsible investment lead for PGGM's listed real estate securities portfolio. And so if you're not familiar with PGGM, in short, we are responsible for overseeing the third largest pension scheme in Europe. So we have approximately 300 billion euros under management. And as Peter mentioned, of course, pension funds are large real estate investors. We have a sizable portfolio, and we cover all shapes and sizes of the asset class. So I would say about 95% of it is indirect. So it's that orange circle that Eric just presented. So that's in things like REITs, publicly traded property companies, corporate bonds, both vanilla sort of non-use of proceed bonds, but also green bonds, which is a use of proceed. We have residential mortgage portfolio, and of course, we have a very sizable private real estate portfolio that is largely through commingled fund vehicles, but it's also more and more through direct property investments as well, through co-investments. And I sit on the listed real estate team. And my job is ultimately to help our active bottom-up fundamental strategy use ESG information to make a more comprehensive picture of the companies that we cover. So I cover about 200 companies. So I have a global purview. And of course, with that comes the stewardship as well, to make sure that we are able to transition our portfolio to a low carbon and socially inclusive real estate portfolio. So that's my intro. Thanks.
Oh, busy. I'll have a few questions about that in just a second. And before I hand over to Elena, I would like to invite participants today to share their questions via the chat. We have a few questions for our panelists, but if there's anything that you'd like to raise, please do that via the chat. Elena, good morning. Very early morning for you. Thank you very much for joining us today.
Yes, good morning, and good morning to anyone else in the Americas who got up this early or is watching it on replay. My name is Elena Alschiller. I'm the head of sustainability for the Americas at LaSalle Investment Management. We're an independent subsidiary of JLL with about 79 billion assets under management globally and 5 billion square feet. That's across all asset classes, primarily private equity, but we do have some security and debt business, commingled funds, separate accounts on the private equity side. And then my job, as with the sustainability team, is really to drive sustainability at the assets, right? Everything from setting goals and developing processes and resources to implementing the activities at the assets, and then all of the voluntary and regulatory reporting we're doing on the other side. I should also mention, as relevant to this conversation, I'm chairing the CREM North America working group with CREM, ULI, and LBNL, and we're just about to launch a process to further refine the CREM curves for North America, including the US and Canada. So if you're interested in that project, please do look it up and join our working group.
Thank you, Elena. For anyone that's gone through the standards document and through the accompanying technical guidance, they'll see these are very extensive, very technical documents, and indeed a lot of effort and expertise went into compiling them. If you could please explain, maybe in simple terms, for the wide audience that's listening to us today, what problems do these documents help you solve, especially since we're dealing with such complex portfolios and global portfolios and multiple teams. And Andrea, maybe we can start with you.
Sure, thanks. So first and very foremost, I think that this is solving for us. The reporting side is okay, but it's actually for us solving information quality for us to be able to price risk correctly. So, I mean, this was actually made for the sake of reporting purposes, and some other analysis. However, for us, given the existing loose standards in the GHG protocol as they stood previously, we were using information. We're actively trying to use this type of data in our stock underwriting and our stock selection process. But the quality was so poor that we just could not make sense of it with various different conditional boundaries or organizational boundary approaches, use of scope 1 and 2 or 3, how we define those things. So you're constantly comparing apples and oranges and trying to take the same outcomes on them when you price them into a company underwriting. And that simply didn't make sense for us anymore. So I think that this document adds a lot of clarity, it gives a lot more precision to the way that the carbon accounts look like for different companies. We're largely indirect investors, so we have to aggregate not just individual buildings, but lots of individual funds, companies, and portfolios into one large portfolio. So we ultimately get, we got up until this point a bunch of different versions of what should be the same. So now ultimately, I think we have one huge step in the right direction to be able to, with a larger conviction, take decisions on this information.
And do you have any internal mechanisms in place to make sure that this guidance is properly understood by the companies that report to you, that the data that you get is actually in line with what it's supposed to be? Because you did mention part of your role is also a stewardship role in bringing together all these companies and perhaps also helping them understand better their role.
Yes, that's absolutely right. And we get every level of professionalism, frankly, on this topic. So we get everything from very, very excellent, the ones who actually teach us something, all the way down to they have never even considered carbon accounting. And I think it's a long way away still, frankly. So we get every flavor, and we have to approach it differently for each level of professionalism on their own journey, because otherwise, if we meet them where they are somewhere else, then we don't really make any headway. So to give a bit of background, I mean, we also very much rely on GRESB. I mean, it's for us as such a large investor, we consider GRESB a data aggregator, right? So it's for us, we can hit the data download button and we can get all of these line items in a very organized way. So that already is step number one for us, is to continuously ask for companies to report to GRESB, because the alternative is me basically copy pasting numbers, changing commas to decimal points across the globe, changing megawatt hours to kilowatt hours, etc. So that's not really suitable. So that's already service number one. When it comes to applying these technical guidance standards directly, I think the U.S. is in a I would call a holding period, given the Securities and Exchange Commission's guidance. So they are kind of not doing anything at the moment, I would say. Alternatively, anyone who is in that early phase, in the sense that they have not started, have not thought about it, they get to leapfrog. They get to leapfrog all of the growing pains that the leaders have had to experience themselves over the last decade, right? So now we have this really amazing document that they can simply refer to and take choices immediately. So yeah, those are the things that we have in the pipeline.
Great. And actually, I see you've partly answered one of the questions that came in. Elena, I'll look at you with the same question. How does that align with the GTM strategy?
Yeah, so I thought it was interesting that we said earlier that this was an audience for the financial industry, because we know that all of our partners like PGGM are going to turn around and ask us for this data. So I actually saw the document as clarifying a lot of the open questions that the industry has. Do our investors want whole building reporting or not, even when it's estimated? How to handle the breakdown between landlord and tenant data. And it says the same thing GRESB says, which is if you can't tell, it's the landlord. How to handle F-gases, market and location-based emissions, how to scale up partial data, weather to weather normalize. All these questions we're dealing with day to day as practitioners. And I know we've been having a lot of conversations internally on what we think the best position is, but regardless of what stance LaSalle may have taken, if it's inconsistent in what's being reported to our investors, it can be misleading to our investors just because we're taking different methodologies or using different assumptions in a way that is not representative of the actual difference in the underlying performance of the assets. And so on the one hand, I think this document is great because it lays everything out super clearly of everything that they're asking for. And also, y'all are basically saying that you want everything. And so it is very ambitious in terms of what it's laying out of what needs to be reported, but it has very clear steps about data estimation, which I think is one of the key areas where it's helpful.
So in general, you provided a good summary of how these technical guidance principles are applied in your business. Do you find that your work is now much simplified, or perhaps more information brings more questions on board? We often hear from companies that report to GRESB that they are concerned that maybe investors don't always understand what the information that they provide, that this standards and guidance doesn't always include every single specificity and every single edge case of what's happening on the ground. So how do you bridge for those situations, and how do you make sure that the information is properly transferred from one side to the other? And now this is the same question for Elena and Andrea, but obviously from different perspectives. So Elena, would you like to start?
Yeah, I mean, I'm hoping that this will help clarify a lot of that, because we see that, we get these customized investor requests where everyone has written their own description of the information they want, and it's going through so many steps between us giving them the data and they just want us to fill in one cell. There's no opportunity for context there. And so I think a lot of information can get lost in translation. So at least having a standard method for providing that information, standard definitions and methodology, is going to really increase the consistency and hopefully help with market awareness, understanding of these metrics. I think one of my big takeaways from reading this document in terms of where we need to go next are, first of all, we need some standard assumptions for this estimation, right? So our data set, we have about 70% actual data, which we're really, for those of you who are tracking data, know that's actually pretty high. But if we're comparing to a portfolio that has 5% actual data and has estimated the rest using really nice, perfect numbers, that portfolio might look better than ours, right? And so that's where, I think all of this transparency is going to be really helpful. But we're not going to get to the bottom of the inconsistencies until folks are using the same source input assumptions for that missing data. So I see, I'm really looking for where those, in each country, the standardized data sources are, and the tools, whether those are available broadly or provided by the, consulting and software partners we have, to automatically do the data estimation and the scale up according to these rules for us, right? So that it can really be standardized. So I'm looking for those assumptions and tools. The last thing I'll mention is the guidance was really helpful for us in identifying our gaps, right? So it lays out pretty clearly that you should be reporting F gases, which is, I think, something we're all on a journey on. And it also is pushing towards increased time granularity and in matching your grid factors. And so those were like places where I started and said, okay, those are places where we know that's where the industry is going to be pushing us now. And even if we don't have that data now, that's where we should be going in our program design.
Thank you, Lena. Andrea, anything to add?
Yeah, I think for us, it's, to Elena's point, especially on the receiving end of the reported information, when we're trying to translate data to insights, we need that context. So numbers, otherwise, without sufficient context, are just numbers that actually don't mean anything to us. So we do read the open text boxes, number one. We do read the footnotes. We do the things that are necessary to make sense of the information in light of the current situation, whether that's geography, whether that's asset type, whether that's lease type, whether that's like target tenant type. There are all these things that we need to contextualize the information with to understand what is the impact on the business. So that's the translation that we tried to do on our side. But I recognize that, you know, with that level of skill, it is complicated to contextualize in the right way. So you have to find a balance between spending 3 weeks analyzing one company versus making efficient insights that we can use at scale. I think otherwise, I think that summarizes actually.
I'll just add, that open text box is really important, and we'll be able to write less things in it now because this has answered a lot of the things that we would have to clarify. And so we can really narrow down, this consumption change was because we bought one big asset and sold another big asset or something like that. That would be better, useful information for you.
Indeed.
So it sounds like it's standardizing the reporting process, which is great for standard. What would you? Obviously, the two of you are very well versed with the guidance. You've been involved in the consultation process, so you've been following it and its details throughout time. How would you advise anyone that's just looking into it and starting to make sense of it and starting to interpret it? How would you advise them to go about it, and what notes would you give in terms of pay attention to this? This is perhaps different from what you might have expected. Were there any surprises for you in the final outcome, or when you read? I'm not sure if you actually read the thing from top to bottom as literature, but is there any advice you would give to somebody that's just starting to understand it and apply it?
Maybe I can have a first go at this. So as a pension fund, every pension fund will have very complicated portfolios. Very, very complicated, very large, right? So actually, if from the pension fund's purview, my recommendation is to not get overwhelmed, to take it step by step, because otherwise, if you try to do everything at once, it will overwhelm you and it will become pretty much impossible to do right. So take it step by step, start with your equities, maybe then your fixed incomes, or for example, real estate, where you have pretty good access to information. I think way better than on the equity side, way better than on the fixed income side. So start where you can make the best gains actually in this. And then further from the real estate company side, I would say, hey, look, just start to follow what is already industry practice. Take the operational control approach, please. I beg you. Don't go for the financial control approach because it's so rare that it doesn't make sense actually to use it within the real estate ecosystem. Maybe outside the US for the SEC, but let's see. And to just start not reinventing the wheel. That's the whole purpose of this. So I think those are my main recommendations.
Elena, what would you wish you would have known when you started with this process? And you can
I wish this document had been out before we started working on our baseline. Can't change that though. But what I will say is, there's really helpful summaries at the end of each chapter with a few bullets of the key takeaways. So you can start there. But sort of more seriously on the content, one of the messages that comes through really strong is our investors are going to be looking for whole building data. And they are expecting us to be able to separate landlord and tenant and to estimate missing information for landlord and tenant separately. And so that is that's very ambitious, but at least now it's set out that expectation that okay, report what you have, estimate what you don't have, and disclose the sources of that estimate. And as you all know, that's going to be a little bit different from GRESB, right? So you're going to submit all your actuals to GRESB, and then you'll probably do this extra step of scaling up, or maybe some industry partners will step in with some tools to help us with that scaling up step. So I wrote down, okay, here's what we have to be tracking as real estate owners. Whole building broken out into landlord and tenant. It's saying shall for F gases, so you need to be estimating F gases if you don't have it. But in use and upfront embodied carbon are recommendations, so that is something to move towards in the future. They want both location and market-based emissions factors, and then all of the missing data estimated and scored. And you know, that again, that's very ambitious, but I think what we've gone through in our reporting that's about to come out, basically when this came out, went back through a report that's about to come out and said, okay, wherever we don't have something, you know, we're just going to say, we're working on it, or this is our plan to go towards it. So you don't have to feel like you're doing every single piece of it today. You can say, you know, this is where we weren't able to do it exactly as the recommendation. This is why, or this is our plan to do it in the future, or whatever.
Yeah. Eric mentioned a bit earlier, this is intentionally named version 1, just knowing that there's always room for improvement, rectifications, updates and amendments. What would be your hope of next step for this set of guidelines? What is it missing right now that you're hoping would be added to a next version in the future? Not to put any pressure on the group, but we have you here, experienced users.
Yeah, maybe I can just. Elena, please.
Oh, sure. As I think I mentioned, you know, those estimates are going to be really crucial, and I would really like to see standard assumptions by country and by asset class, at least as a guidance, because otherwise, even with the standard methodology, if your inputs are not standard, you're still going to get incomparable results or less comparable results than you would with just a standard methodology. The other thing that I know is not in the control of this group is, geez, I hope the SFDR and the SEC will accept the same thing that you all are accepting and asking for. So, you know, it'll be important to really keep an eye on all these regulations and other reporting frameworks and hope that everybody falls into line with this. Because if we really put effort into calculating things exactly this way, it would be great to report the same data to all the places where we're sharing it.
Perfect. Thank you, Elena. Andrea?
Yes, I think to echo Elena on this one, the regulatory system is evolving at lightning speed. So what we don't want to have to see happen is reslicing, redicing all the time for different end uses or different regulatory environments. I think, frankly, for the near term, that's probably the way it will have to go. But maybe then, you know, someone has to be the superseding line in the sand of what gets reported to what particular entity. So yeah, that we'll just wait and see. On the methodology itself and the technical guidance itself, I think it's really excellent for the case of Elena, for example, where they're direct investors that basically buy buildings and own buildings and have to aggregate buildings. At our level of use, we're one kind of degree higher in the chain. So we have to aggregate portfolios of buildings. And I still think for that level of aggregation, there are still some gaps. But nonetheless, getting the line items of individual line items calculated in the same way, for example, Elena, for us would be one line item that we would need to aggregate many line items. So getting that basis is critically important. So that's the huge step in the right direction. But then for us, aggregating up the chain is there are still some areas for where we need to basically fill in gaps. So hopefully those can be solved in the near term. But in any case, one thing that Elena mentioned that I do want to quickly touch on is the whole building approach. And I get so many questions from companies, why do you need this? Why do you need this? And I ask them, so hey, should I be only underwriting your hallways? When I'm underwriting your building, that doesn't make sense. Why would it make sense from an ESG analysis perspective? It doesn't. So that is why, because we have to underwrite a whole building. We also want to do ESG analysis for a whole building because you do not just sell the hallways, right? So that's one. And then to the point about embodied carbon being a recommendation, I think that should evolve to be a requirement. If you have development activities, we need to see it. That's the story.
Perhaps we can organize another webinar to discuss only that part. But for now, I would like to thank you all for attending. This was a great conversation. I would like to thank the speakers, Peter, Sven, Eric, Madeline, and we know that you might still have questions. Obviously, this is an incredibly important and fantastic standard and a huge step for industry to standardize and speak the same language. These things will never be perfect for everyone collectively, but they do solve a lot of problems, and we're excited to see the next versions of it or the next steps. So thank you everyone for joining. You will receive a follow-up email with more information about how to access the webinar today. And with that, I thank you and have a great day.